I think that 17% of people under the age of 55, I actually think that's a better, I'm just saying to Jack, I think that's a better than I would have anticipated stat. I think off the top of my head, average pension size by the time someone gets to 57, so the earliest that someone can access a personal pension is circa 30,000. That's 30,000 total pot. So I think 17% is actually shocking. I thought it was actually, I would have thought it would have been more, but in terms of what advice would you give to someone that might be hesitant to make pension contributions, I think you need to think about the future. That sounds quite big picture, but how, if not through a pension, are you going to fund your retirement? Pension brings with it the most tax efficiencies, or more tax efficiencies than most other investments. There's very few investments which give you tax relief at your marginal rate. So if you're a basic rate taxpayer, you get 20%. If you're a non-rate taxpayer, you get 20%. If you're an additional rate taxpayer, you get 45% uplift on any of the money that you put in. So I think if you're hesitant to do it, you need to be aware of what the benefits are and what the alternatives are, because the alternatives are never as attractive. So I think pensions by far are probably your easiest and quickest way to build a substantial pot over and above other options, in my opinion.
Yeah, absolutely. I guess a lot of people are slightly hesitant about it, particularly from a sort of expense point of view, particularly at the moment. Obviously, inflation and the cost of everything is going up over time, but ultimately, again, you do have to sort of step back a little bit and think about that bigger picture and say, ultimately, it will go back down again. There's always going to be costs. Inflation is never going to go away. It will always be increasing over time. So you do need to allocate some capital month to month. No matter what it is, it can start very, very small. But the earlier you commit to doing that, the easier it is. It just goes straight out your bank account. And ultimately, if the money's not there, you don't notice it. And as long as you're able to afford those expenditures, just doing it little by little, it eventually will add up to something fairly substantial. So yeah, I think that's probably what from my side, just being able to have it just every single month, an automatic thing. You don't have to think about it, and it will just slowly build and build and build. And particularly if you're young, you start out nice and early, you'll be amazed with compound interest and everything else, the size of that pot that you'll get to eventually. So yeah, I think that's probably what I'd think.
Correct. I think also, like, if you think about, just to Jack's point, if you think about the cost of living, inflation, most other alternatives will mean that actually you're at a net loss to the cost of living, the cost of goods at that point in time, whatever that will be. And obviously the pension itself doesn't sit in cash, or shouldn't be sat in cash. So the idea would be that the money gets invested into assets which remain on par, if not give you some positive net return over and above where inflation stands over that period. So really and truly, you can buy the same, if not more, of the same items today with an inflation-linked investment through things like equities, property, fixed income, not so much, but in terms of real assets to provide that. I think it's certainly a positive. I think from what I've seen of it, we've been quite slow to the uptake of this. I think the US have allowed like 10%, from what I gathered, into early stage businesses for a very, very long time. So that clearly stimulates that part of the economy and that part of businesses, because it might be a space without these kind of reforms and these kind of tax incentives, not tax incentives, but these kind of incentives to drive money and funding towards these kind of businesses. So you start to get a whole space of companies which are being funded through government incentivized schemes, which then will only benefit from that space in its entirety. I'd also say that a lot of retail investors probably wouldn't get exposure to this space historically without the use of a professional, us or someone similar. So having it as a pre-baked in option or alternative to public markets, I think is a good thing. Obviously brings diversification, which is huge. And I think historically private markets will provide more upside than public markets, although there is elements of volatility in that and liquidity, I suppose, issues.
Yeah.
But this is all, having it being done through the government incentivised scheme, I think is only a benefit.
Yeah, I think it's a really interesting idea. I think with the sort of stipulation, it is, rather than sort of having an option to do it, it's now getting mandated to do it,
Yeah.
and so it is going to form part of people's investments, sort of whether they like it or not, from a obviously listed sort of equity perspective, and obviously as we well know, it is a risky environment. Obviously we have exposure through one of our funds. We've also got sort of venture capital trust investments and things we can obviously assist with. So yeah, it's about obviously understanding the risks and knowing that it is hard to price that some of those assets. It's not going to get updated every single day. It's going to have periods of significant volatility, particularly in instances like the moment where obviously it is very difficult to price an office building at the end of the day, and it's hard to know where those sorts of things fall. So there is an element of risk there, certainly, which I think people should be aware of. But particularly for the UK, we have been quite good, I think, at sort of promoting small business, at getting sort of ahead of things, and obviously there is a huge amount of capital investment that comes in to that area of the market through that VCT scheme, through the EIS schemes that the government obviously support through that tax relief. So yeah, it's only a good thing from that perspective to try and further that industry, and obviously there's a lot of talk about sort of digital currencies and those sorts of things as well, which are forming a large part of some of the other sort of incentivisations they're bringing in with these Mansion House rules. So there's definitely a big focus on sort of the next stage, I guess. It's the sort of after leaving the EU, there's going to be potentially more control over regulation, therefore we can try and sort of carve out a bit of a niche from sort of our perspective in terms of where we want to sort of go over the next 10, 15, 20 years. So I think it's certainly a positive step, and it provides a lot of options. So yeah, it'd be interesting to see how it sort of starts to develop, particularly from a fund basis. So it's going to be 5% of default funds will have to have exposure,
which is probably enough, isn't it, for
absolutely,
like liquidity and pensions and people taking incomes and that kind of thing.
Yeah, exactly. So yeah, be interesting to see how it sort of starts to be brought in over the coming years. So we've got still sort of it's 2030 that they have to bring it in.
Is that what
so
it is?
we've got a while, but be interesting to see it develop.
Neutral.
Yeah.
By 2030, is that still the date? I think it
pretty
is.
much, yeah.
And implementation.
It's a big year.
It is a big year, yeah, absolutely. How old will you be in 2030?
I can't say that.
Not willing to say that on camera. The other thing as well is that the UK has been, or has historically been, over recent times, it's slightly less attractive for companies to list in the London Stock Exchange.
Yeah.
So I'm sure this is another way for them to, when I say them, I mean the government, to drive a more attractive environment for businesses to list, or to at least grow in the UK.
Absolutely.
Rather than losing out to obviously New York Stock Exchange and people listing out the US and whatever else. So I think that whole trying to provide more of a fertile ground for tech and growth focused businesses to take off, this is certainly going to be a huge thing for that. And it will hopefully stop losing out so much to the US, because you look at London, the reasons why people tend to list in London is time zones, access to finance, legals, obviously within London and whatever else. But the reason why people go to the US is similar. Funding is more well-trodden ground for tech businesses. So hopefully these kind of things try and make us slightly more competitive in that space. So in answer to that question, I think it's a good thing. I think it could have been done much sooner than it has been. And I think in terms of retail investors, if I can use that term, getting access to this without actually having to make a decision on whether they should or they shouldn't, I think is a great opportunity. How do we ensure protection and growth? Jack mentioned a really good thing, which I wasn't aware of actually, just going back to the Mansion House reform, is that pension schemes will potentially now trace an individual rather than an individual having multiple pensions through historic employers. So I think in terms of what measures can we take as financial advisors is continue to support clients that have maybe built up various schemes with historic employers and providers prior to this piece of reform coming in. I think it's continuing to educate people. A big part of what we do is discussing public, private markets, cash reserves, investment options that are appropriate to people on a short, medium, long-term basis. So I think continue to educate people, continue to be their sort of window of being able to take a view on these things and make sure people make the right decisions. In terms of protection, I think the same protections will exist when these reforms come in, and that is with us as a pension provider. The way that we structure the pension is something along the lines of long-term dated contracts, so that actually you're covered to no upper limit by the FSCS, whereas through some SIP providers you're only covered up to 85,000. So depending on how this reform changes that, we'd always try to make sure, I'm sure SJP tries to make sure that clients are covered to the or in the best way through not just us but the FSCS as well.
Yeah, absolutely. I don't think I have that much to add, to be honest, on that point. I think ultimately, it's about making sure we keep clients educated, they understand what risks they are taking, they're looking at timeframes in particular as well, just around sort of the point at which they are looking to exit, decumulation and all those sorts of other elements, which is a very complicated time, and having help and advice on how to do that, how much to take, where to put the assets over the next 5, 10, 20 years, because you are going to be decumulating for a long time as well as obviously building the assets. So it's about just making sure we've got sort of people in place that can have those conversations and just sort of hold your hand, I guess, through those various sort of turbulent periods whereby you do have to make big decisions, and ultimately you have to make sure that the investments that go along with those are going to be appropriate for your position as well. And from a growth perspective, I think certainly this offers a great opportunity. Individuals that can afford to take risk, generally obviously the younger individuals, they're able to put a portion of their portfolio into something that could deliver very, very good returns. Again, obviously the risk is much higher, and therefore we have to be sort of aware of that, but ultimately the protections are in place in that if the sort of company collapses, then therefore there's a protection. There's not such a protection from the actual investment standpoint, so obviously there is always the risk that any sort of private equity money could go to zero ultimately. Any money could go to zero.
That's why I suppose the allocation is...
It's about controlling that allocation from that perspective going forward. So it's all comes down to that risk return and obviously the reward that you hopefully will get at the end of that. And also being able to manage that.
Personal pensions, through what we do, SJP will continue to have to take note of what the government are doing.
Yeah.
And for some of the off-the-shelf portfolios that we offer, I'm sure that there'll be a small element of allocation which continues or grows in terms of its exposure to private equity and those kind of industries.
Yeah.
We certainly won't get left in the dark from where that's concerned. But in terms of growth, I think it's just continuing, like you've already rightfully said, make sure someone's comfortable with the risk they're taking, what that means short term in terms of volatility, and also what's the opportunity cost if you don't go in equities and you stick with fixed income or cash or whatever it might be. And I think that just comes down to the education piece.
I think ultimately that is the key benefit that we provide to clients. It's being able to educate them around the investment, being able to educate them around the risk that they're taking. A lot of people unfortunately don't really know what they're invested in. A lot of people probably aren't aware of the Mansion House rules, so it's about obviously being able to spread the word, obviously ensure that people understand that level of risk they're taking, be able to educate them, and then ultimately obviously deliver on their objectives and make sure that we are going to be aligned accordingly. Yeah,
I think like you look at post-trust quasi as well, what would be your safe havens, asset classes, have obviously not reacted so well in certain market.
Very true,
in certain environments and post certain news being coming out to markets and the signposting of that news to markets. So having something that's maybe slightly more alternative and gives you a different exposure to a different space, which might not be so positively correlated with decisions that get made around the government, using that, using the mini budget as an example here.
Yeah.
I think using private equity is a really good way to try and diversify and give yourself that alternative coverage.